Welcome back, everybody, to the Biz Beat by SVA, where we focus on what business owners and leaders need to know about tax, policy, and financial strategy. I'm Lee Schwartz, Director of Business Development and Sales here at SVA Certified Public Accountants, joined, as always, by our tax partner and president, Eric Trost. Eric, how you feeling?
Pretty good, Lee. How about you?
Good. Before we got started, you were all excited about the recent news about Taylor Swift and Travis Kelce getting engaged. Do you want all of our topics to cover that today or just maybe the first one?
Actually, it's such a big topic. I think we should save a next show on it, hour long. I've been trying to get her to respond to my text to come on our show as a guest. And so far, there's been no response.
You know, she was just on his podcast. So she's now, she's good at podcasts. So she really has no reason to say no.
Right.
All right.
And all exposure is good exposure, right?
Exactly.
I don't know why she would not want to come on here.
It really would benefit her more than us, but Probably. That's fine. All right. We'll reach out to her people again. All right. But quick reminder before we jump into our main topics today, if you're trying to keep track of the One Big Beautiful Bill Act, head over to sva.com/OBBBA, where we've got summaries and FAQs and biz tips and recorded webinars, all sorts of fun stuff tailored for business owners. So you can check out great information there. But Eric, let's jump into, here we are. It's the end of the summer. Kids are going back to school soon. Some are already back. So let's talk a little bit about 529 plans and how parents and really anybody can use those to help children with future educational expenses. Do you want to just give our listeners kind of an overview of what 529 plans are?
Sure can. First, a quick shout out to all the parents whose kids are going back to school and you get that meat part of your day opened up again. Someone else takes care of them for a while. Yeah. So, yes, 529 plans. 529 plans are essentially a savings account that individuals can use for their kids' education. So it's a savings account for education. There's benefits to this kind of savings account as opposed to a normal savings account. Normal savings account, you can just open and put money in and maybe invest in stocks, bonds, and whatever. But the income that savings account makes is taxable income. For a 529 plan, those amounts, once they're put into the 529 plan, when they start earning interest, dividends, and gains, those amounts aren't taxed as those amounts accumulate. So it allows you a faster accumulation of funds because those amounts aren't taxed. Now, later when they come out, those earnings still aren't taxed because as long as they're used for the right purpose, which in this case is schooling, then you can take money out of those 529 plans with no tax consequences.
Okay.
So that's the basics, Lee.
Yeah. So great overview. I think one of the things I know a lot of parents struggle with is how much to put in there. Talk a little bit about the benefits, I guess, from a tax perspective, at least maybe from most of our clients who are either in Wisconsin or Colorado, maybe some other states as well.
Yeah, there's no limit to what you can put in there, but there's going to be an issue if you put too much in there because the amounts when they come out are not taxable if they're for schooling. Now, let's say that you have two kids, let's named A and B. Not very creative with your names. You have two kids, A and B, and they each have an account. And A goes to school but doesn't use the whole account. Then you can move those funds from account that belongs to A to B. So you can move funds very easily. But what you can't do is take them out for something other than schooling. Or if you do, you pay income tax on the earnings and a penalty. So you don't want to stock up too much into these accounts because if you end up with no place to go, you can keep it in there. You can move it to another child's investing or a 529 account. But what you can't do is take it out for any other reason. So while there is no limit to putting in, you have to be careful on how much you put in because you don't want to have it end up being trapped in there. Having said that, there is some tax benefit to put money in there because some states like Wisconsin and Colorado offer a tax deduction when the money goes in. There's no federal tax deduction, but there is a state tax deduction depending on the state you're in. So there can be a benefit for a state income tax purposes by putting money in there. So another consideration as you fund the account. And again, once the money is in there, it's growing tax-free and can come out tax-free until it can come out tax-free if it's used for college education, or there's other education you can use it for. You can use it for high school, private school education. You can use it for less than high school. So it can be used really on a K through 12 up to $10,000 a year. So there's a limit on non-college education at $10,000 a year, but you can still use it for private school as well. One other thing about the 529 plans, there's not, you don't have to tell the government necessarily or show them receipts for you're taking money out. So let's say you get to the end of the year and you spent out of your pocket $20,000 on college education. And so how do you get that money out of the 529 plan? You just request it to take it out of the 529 plan. So you go wherever it's stored and you say, I want to take out $20,000, and out it comes. And then the 529 plan keeper will send you a 1099 and say, hey, you took out $20,000. But as long as you used it for schooling, you don't have to pick that up as income. You just have to save your receipts and how you came up with the $20,000 if the IRS would ever ask about it. But you don't have to submit any of that with your tax return. So it's very easy to get money out and get reimbursed. You just go into the account and request it.
Okay. And if you did, for whatever reason, decide to bite the bullet and take it out for an unallowed reason, what are the penalties?
Yeah, so there's a tax on the earnings. So how I said earlier that the earnings aren't taxed as long as it comes out for education. If it comes out for another purpose, then those earnings are taxed. So you have to figure out, well, what are my earnings on this? I put in, let's say, $5,000 a year for 10 years. That's 50,000 that went in. If the account balance is 80,000, then you have 30,000 of earnings. So you have to figure out what portion of what you took out is earnings, and that's subject to income tax. And it's also subject to a 10% penalty. So it's not a cheap way to get money out if it's coming out for something other than schooling.
Right. It's a hard thing to plan for as a parent, especially your kids are young. You don't know if they're going to college, if they're going to a
Right.
state school, if they're going to a private school. I don't know, when you talk to your clients about this, like, what do you tell them? How do you tell them to plan for this?
Yeah, because they're flexible to move around to other family members, they're good accounts to have. You get the state benefit from it. But I think you have to start weighing those in, I guess, comparison to what's coming up with the Trump accounts that are going to start next year. So there's pros and cons to each, and I think it just adds to your reasons to talk to a financial advisor.
Great. Okay, so let's move on now to our second topic. A couple weeks ago, we talked about some interesting business arrangements that Trump started with some chip makers and what they're selling to China. Now there's been some interesting information around Intel. You want to talk a little bit about that and kind of what the news that's hit here in the last week or so?
Yeah, this is interesting because it's essentially the federal government taking an equity position in a company. And that did happen somewhat back in the TARP years, which was the Troubled Asset Relief Program back in 07, 08, when real
Yeah, we
estate
got in the
prices
auto
were
industry, right?
bigger.
Didn't we get into the auto industry?
No, well, they did get in the auto industry. This was more for banks, though,
Okay, gotcha.
originally. This was when all the mortgages that all of a sudden became due because people lost equity in their properties. There was a massive sell-off going on. And so in the 08, the market crashed. Some very large Wall Street firms collapsed during that. So that's the last time that the government really got into what otherwise has been private ownership. This is in a capitalist society. Typically the government doesn't own things. That happens in Russia or China. It doesn't usually happen in the United States. Well, it's happening again for Intel. Now, Intel is a little bit of a special case. They're a chip maker. And unlike the chip makers NVIDIA and AMD, they seem to have not had as successful a run during these last couple of years. When a lot of tech stocks have, they have not. So they've had some troubles. And what the government is doing is taking what had been grants and other monies that had been some kind of loans or grants to Intel and turning them into an ownership interest in Intel, about 10% ownership. So the United States government looks like it's going to end up owning about 10% of what was previously a private company, publicly traded, but private company, Intel. And so now the government now has an equity stake there. Doesn't have that in NVIDIA and AMD. In NVIDIA and AMD, what the government did is they put a special sales tax on any chip sales specifically to China. So if China was buying chips, they're going to pay an extra 15%. And that 15% was going to go right to the US government. So that was not an equity position. That was simply a sales tax on chips to a specific customer, which is unique in and of itself. This is another somewhat unique situation in that the government is taking a 10% interest in Intel.
It's interesting, and it's something we haven't, like you said, we haven't seen a lot of. Most of our clients are not Fortune 100 companies, but most of our clients,
all of our clients.
well, none of our clients are Fortune 100 companies, but the question is really like, how does this end up trickling down, and what other impacts is this going to have throughout other businesses? And I think that's what you said a couple of weeks ago, and I'll ask you again, but I wonder if we'll get the same answer, and that is, who knows, and we'll see.
Yeah, well, what the administration has announced is, or some officials within the administration, this might not be the last company that the United States takes an investment interest in, so an equity interest. So this looks to be a little bit of a change of game plan for how companies are usually run in the United States, to have the government take these interests. And sure, Intel was troubled, but this is a little different than what happened back in the TARP years in 07 and 08 when the government took interest. To some extent, that was to provide liquidity for the bank, I guess the financial crisis with the banks, so that they had money. And for the most part, the government got all that money back. They took like preferred shares and provided that liquidity, and then got that money back over time from those banks. So it was kind of like a loan. This one doesn't have that same structure, and what they're announcing right now doesn't seem to be some kind of liquidity investment. It's more like a deal. Like the government is now going to partner up with some of these firms, and what does that mean going forward for businesses, and what happens when the government is your partner? They said they're a silent partner, but a 10% owner, that's it's hard to be silent as 10% owner.
Yeah,
A big company like
absolutely.
that.
Yeah, really interesting development. We will continue to revisit as we do see the ripple effects downstream from that. But let's move on to the mailbag. So, just a reminder, you can send your questions to us anytime at bizbeat@sva.com, or you can drop them on our website at sva.com/bizbeat. So, Eric, this week's question is, and we talked about this recently as a part of OBBBA. I think you might need to explain this question after I say it. So let me get it out there first. But how does the above the line charitable deduction work with the itemized deduction?
Yeah. And so that's a good question. And it's the term above the line that I think needs explaining. What does that mean? So this gets into a little bit of how a tax return is prepared and ultimately how your tax is calculated. What you're allowed as an individual is you're allowed a either standard deduction, it's called the standard deduction, or you can itemize your deductions. And itemized deductions mean that you add up these various things, and if they come out to more than the standard deduction, you can subtract that from your income. So you either subtract the standard deduction or you subtract itemized deductions, not both. If you subtract itemized deductions, that means it's more than the standard. Those are things you're adding up, like your mortgage interest and your real estate taxes and things like that, your charitable contributions. If you use the standard deduction, that means you're not adding those up. They don't exceed your standard deduction. So the standard deduction's higher. You get to use that. What happens if you give to a charity and you're not itemizing your deductions? Well, normally charity is an itemized deduction, so it gets thrown in there and you add those up. If you're not itemizing your deductions, giving to a charity doesn't give you any tax benefit. So that's the downside of giving to a charity and you take the standard deduction. You don't get that tax benefit for doing that unless there's a deduction above the line, which starting now, because of the new OBBBA bill, there is. there's a deduction above the line, which means that this is before looking at standard deduction or itemized deductions, is you can just subtract that from your income. That's what effectively above the line means. You get to subtract that amount prior to making the decision on standard deductions or itemized deductions. And so now there's this limited charitable deduction that you can take that's above the line for $1,000 or $2,000, depending if you're married or single, and subtract that from your income, even if you use the standard deduction. So this is for cash deduction, for cash to charity. For deductions, you do this above the line, which means you're going to get a tax benefit from that, even if you take the standard deduction. So that's the important thing to take away here. OBBBA has essentially made it more favorable for those that use the standard deduction to still get a benefit for making cash charitable contributions.
So one of the things I know we talked about, which I think it was an interesting development in this bill, is that floor for the itemized taxpayers. So if they're itemizing those deductions, and remind me, I think it's 0.5% of, you have to donate at least 0.5% of your income to even have that go towards your deductions, correct? So I guess part of the question, at least as I read it here, is does that above the line deduction, is that a part of that 0.5%, or how do those two interplay?
Yeah, this can be done without taking into account that floor. Now, it's a smaller deduction. So if you're talking about that floor, you're usually talking about, okay, I've got large deductions to these various charities. You have this new 0.5% floor that starts in 26. It's not there in 25, but it starts in 26. Part of the planning that you'd like to do with large deductions, so this is really not what we're talking about when we're talking about this limited above the line deduction. Part of the planning you want to do is, if I have large planned deductions for charity coming up, do I want to look at those and do something in 2025 and accelerate what otherwise would have done in 2026 or future years? And so that's part of the planning you're looking at prior to the end of the year.
Okay, a lot to think about. And then again, like you said, some of these things are in effect already. Some are going into effect next year. So all reasons to be talking proactively with your advisor to think about how these things are going to affect you. All right. Well, thanks, Eric. A lot of information covered again today. That's it for this week's episode of the BizBeat by SVA. Remember, head over to sva.com/OBBBA for resources on the One Big Beautiful Bill. And if your organization or your association would like a presentation on how this might affect your membership, as I've mentioned before, we'd be happy to schedule one and present. Just a reminder, please subscribe on Apple Podcasts, Spotify, or on YouTube. Please share it with a business owner that you think might find it helpful. We really want to get the word out. And as always, these conversations are general in nature. Please talk with your CPA or your advisor before making any decisions. And if SVA isn't your CPA or advisor, let's give that a change. Give me a call and we can talk about how to make you a client. Thanks again for listening, and we will see you next week on the BizBeat by SVA.
It's the BizBeat by SVA, breaking down the news of the day, from tax tips to business trends, smart insights from trusted friends. The BizBeat by SVA.